Go ahead, Tony.
Okay. Hello, welcome everyone to this live stream, which is coming to you from the Venture Center in Little Rock, Arkansas. Today is November 2nd, so we're less than a week away from the presidential election and other elections. Regardless of the outcome of the race, one thing is for sure that most analysts predict the outlook for banking and the industry is more of the same, which is regulation, and something we're going to talk about today. With us today is to help us understand the good and the bad regulation and what, if any, that impact has on small businesses, community banking, and jobs. With me is Congresswoman Ann Wagner, representing the 2nd District of Missouri, Congressman French Hill, representing the 2nd District of Arkansas, and both of which serve on the House Financial Services Committee. Mike Montgomery, a former Alltel executive, a board member of Community Bank for many years, and a technology entrepreneur. Collins Andrews, representing FIS, which is the largest financial services technology company in the world. He is also an executive of Systematics and Axiom. And Chris Rentner, founder and CEO of Akouba, which is a small business lending platform for community banks. And Yogesh Pandit, co-founder and CEO of Hexanika, which is a regulatory and compliance reporting system for mid-size and large financial institutions. So thank you all for being here today. Congressman Hill, as you know, the financial technology, or we call it FinTech industry, has been much the conversation really for the last 2 years. In 2015, nearly $19 billion was invested in FinTech and these companies. Most of them were aiming at disrupting the banks, right? So these are anti-establishment companies, the OnDecks, the lending clubs, Cabbage, and many others. But really in the last year, you've seen Citibank, Wells Fargo, JP Morgan, Goldman Sachs, and others, as well as traditional banks, invest more money in the industry. And as such, we've seen a lot of these companies become more bank friendly. And so can you help us just understand, what's going on in the financial technology industry with respect to these activities? Why are people investing money, and what do they hope maybe the outcome would be?
Sure. Well, thanks for including me, and it's great to be on this panel with my friends here at the Little Rock Venture Center. It's always great to be back at the Venture Center. We're doing exciting things here in Little Rock, and great to be on in Google with good old Ann Wagner from the 2nd District up in St. Louis, and our good friends and good colleagues on the House Financial Services Committee. And this is an area that's really important to our country, and it's, I think, being taken very seriously by the regulators in Washington and by the Congress. And this is a key point. And I think coming from Little Rock, I think it's important too. And I want to start there by saying that when we think of FinTech, we frequently think about Silicon Valley, we think about the East Coast. And I've been up to MIT's FinTech sandbox a couple of times in the last year. And those are certainly places for innovation. But we've also got to combine that with access to talent and where people are, where people want to live. And that's why I'm excited that we've got these FinTech activities going on in St. Louis and in Little Rock, in the middle part of the country where a lot of our citizens are, and where they want to innovate and where they want to live with a better cost of living and a better standard of living here in places like Little Rock and St. Louis. Secondly, I think this is an issue of national competitiveness, and this is where I think this discussion ought to go. We want innovation in financial services, and we've seen over the last few years, maybe the last decade, big data go to big data analytics, and now people want to know, what can we do with that data? How can we better serve customers? How can we do better credit allocation because we have access to that data? And that's where I think your $19 billion number comes. The people can now take big data, use it to better serve customers, business customers and consumers. And that's where FinTech, I think, is going to play a major role. It's attracting that investment. How do we create a governmental process, though, that is competitive? And that's what Ann and I are interested in. I'm sure we'll talk more about it today. What can the regulators do and do better? What can federal policy be? What should the next president of the United States have in this arena as a priority? And I look forward to talking about those things.
Just one question for you. So as a former banker as well, so you have all these regulatory entities, right? You had the Federal Reserve, the OCC, CFPB, and a bunch others. Which one of those is the most important to banks and large banks or community banks? Are they all the same, or is there one that's more important than the others?
Well, it's a good question. It's a very practical question. The primary regulators, the Federal Reserve, the Comptroller of the Currency, the FDIC, the National Credit Union Administration, for example, all work in an interagency process that's called FIFIAC, the FFIEC, the Exam Council. And they try to collaborate, and when they design an exam model or exam module, that they work together. But there's a curveball in that process now, and that's the CFPB. The CFPB doesn't have the same statutory creation. It doesn't have the same mission. It's not interested in safety and soundness. It's not interested in innovation. It's not overseen by Congress in the same manner that those other agencies are. And so I call it sort of a curveball in this process, because the other primary regulators that examine financial institutions have a vested interest in the safety and soundness of the institution and it serving the public and being successful. And I'm not sure that's clear at the CFPB. And they tend to make rulemaking by enforcement action. So if we didn't have the CFPB, I would say that our primary regulators would collaborate on what is the best way to facilitate innovation for our existing banks through sandbox process work or product review and approval work. And all this applies to the SEC as well, the SEC and FINRA, which oversee the securities industry. So that's my initial reaction. I think there's a normal way to go about it with our primary regulators, but there is a curveball. There's an unusual element in here, which is how do we approach the CFPB, because they don't follow the same rules.
Congresswoman Wagner, you care to weigh in?
Absolutely, and good afternoon to everybody, and wonderful to be with my colleague French Hill. Good to see you. How are things in Little Rock?
Spectacular. Only weakened by the fact that you're not live with us here, Ann.
Yeah. Well, I'll tell you that last week, French, I got to visit 630, which is a FinTech venture fund and accelerator right here in the St. Louis area. It's in downtown in the T-Rex space, which is just absolutely spectacular. And we had a good and lively discussion about the role of FinTech and I was trying to learn a little bit more about some of the exciting companies that are actually being developed and grown in the very exciting and what I would call collaborative space. Now this of course follows up on a visit that I was able to make with French Hill and to the Venture Center in Little Rock, where I think you all are right now, and I know that they're also working together on a number of exciting projects. 630 specifically has taken, I think, a very interesting and very unique approach in kind of selecting and nurturing companies. While so many of these investments for startups will always be available anywhere in the country, 630 stresses that revenue is the best form of capital for a startup, and it helps their companies develop workable and strong products. And I have to agree with my friend French Hill that the Midwest it's where it's happening, and we have such strong, I can say here in St. Louis, and I know that you all do at Venture also, strong corporate partners in the St. Louis area that are helping to contribute and to mentor, and they add to the template for success, as well as we're having a lot of collaboration with our regional chambers and their financial forums and other higher education entities are all at the table. So the work of 630, the work of the Venture Center, I think it's very critical in this new and fast growing industry, I have to say, which is largely grown as a necessity for a lot of the overregulation that you've begun to discuss here, that we've certainly seen in the banking sector. And our regulators need to build on this innovation and help find ways, I think, to encourage its growth. So I look forward to talking a little bit about that. legislatively here, and getting input from all of those that are on our Google Hangout here. We have seen some groundwork, I think, in the U.S. House. We had a resolution, House Res 835, which I do think laid the groundwork for this, and will help us to better foster innovation and recognize this important and growing rule. This resolution is expressly, that was passed in September in an overwhelmingly bipartisan fashion, expresses the sense of the House of Representatives that the U.S. should adopt kind of a national policy, as it were, for technology to promote consumers' access to financial tools and the online commerce to promote economic growth and consumer empowerment. So we've begun to, I think, continue to build on that as groundwork, but it's exciting. And I want to make sure, and I know that my colleague French Hill does, Congressman Hill does also, that the proper oversight is there, but we don't want to have this overreaching regulatory burden that will stifle innovation and growth and access to capital. So I think that's the kind of ongoing discussion that we're going to need to have.
Thank you, Congresswoman, and thank you, Congressman, which is a great segue. So really, for the balance of this live stream, we're going to hear from two technology companies that actually worked here at the Venture Center that we invested in through an accelerator fund. And so first up, you're going to hear from Chris Rentner, who is the CEO and founder of Akouba. Chris, why don't you tell us a little bit about who you are and why did you start Akouba?
Absolutely. Gary, thanks for having me. Congressman and Congresswoman, thank you for participating today. Very appreciative of the support for House Resolution 835 and a number of other things that you guys are doing on the House Financial Services Committee. So thank you for your commitment to technology companies, startups, and small businesses in general. As the founder and CEO of Akouba, a lot of my history played into the decision to start this company and build it the way that we are. I'm a veteran of the United States Navy Reserve. I had family members that were small business owners, and I saw struggle when it came to getting capital as they were growing their businesses. And then through the market downturn in 08 and then the recovery over the last 5 to 10 years, I saw a lot of financial services companies coming to light and raising lots of capital and growing quickly on the backs of consumers and small business owners, sometimes at interest rates that were very frustrating. And so building a company that we have done where we built a new type of technology that we could bring to the community and regional banks so they could meet their customers' needs in the entire country and meet their needs using the proper tools and the low cost of capital that these banks are afforded was what our main goal was. I think the downside is that the banks have a lot of regulatory issues associated with them, and we are trying to help them. An example, Congressman Hill, you brought up the CFPB being a different type of agency today. And one of the, I guess I would say, laws that they're working on implementing is Dodd-Frank Section 1071, where where all banks are now required to, eventually will be required to collect data about small business owners, demographic information, geographic information. And so it's continuing this high level of regulatory burden for the banks. And we sit here as entrepreneurs and problem solvers to try to find a solution to make this easier for them. So I'll pause there just for a quick second about what we're doing when we're trying to help small businesses and community banks, not just with their lending process, but also with their regulatory concerns as well. And I'm happy to answer any questions about what we're doing or talk more specifically about how we're helping banks and small businesses.
Hey, Chris, this is Gary. So I have the first question, and I'll turn over the panel for the rest. But so as a FinTech startup, can you tell us a little bit about barriers to entry in this market? So how much did it cost you to get SOC 2 compliance and that other stuff that really is just the ticket to be able to go talk to customers?
Yeah, so I mean, everything is relative, of course, and I can't disclose all of our private financials, but I can tell you that it has taken us multiple millions of dollars to get to a initial product that is going to meet the compliance, security, and regulatory standards of banks, and then to be able to go sell that product to those banks and make them feel comfortable that our product is viable and meets the needs of what they have today and what their customers have today. So, you know, we're very fortunate that we have a strong investor base and a very knowledgeable investor base, but the barrier to entry is not like your, what I would call typical Silicon Valley startup, where, you know, you can build an app and a minimum viable product and have a product out there that can get tens of thousands or hundreds or even millions of customers without a lot of infrastructure being built ahead of time.
Gary, you know, that's a point I think it'd be good Mike Montgomery would have some comments on this too, but one of the challenges for our startup companies, big time, is meeting the vendor tests that are required by the primary regulators under their IT exam. Vendors have to pass a very strict set of standards, including asking if they have a SAS 70 report and things of that nature, which all startup businesses absolutely would not have and would not spend the money for. In fact, I'm sure in the compliance department at FIS, people still complain about producing a SAS 70. But that's one of the benefits, I think, of partnering in this industry, like the approach FIS has taken here at the Venture Center, where we get the product innovation, but then there is a roadmap, some guidance on how to do this major compliance issue. He mentioned the HMDA for small business loans as a compliance challenge. But Mike, I think it might be interesting, all the work you've done in this space, about that documentation so that a vendor, one of these new startup companies, can pass the IT vendor part of a bank exam now. I'm sure you've had experience of that.
Oh yeah, we actually have gotten forms to fill out that actually exceeded all of the volume of documentation that we create for the applications that we offer. The funny thing about all this is that, frankly, it's a lot of work to go fill out all those forms, do all this stuff. It's a lot more work to do that, provided, than it is to actually comply. We've had not a lot of trouble with operating safely, getting the right certifications, but we use outside vendors for an awful lot of that. Amazon, you know, Rackspace, and guys like that are kind of way ahead of any place that we could ever be. Right. But the banks are being forced to fill their files. I would submit that the banks aren't really looking at anything other than to make sure you've filled in the blanks, and the examiners are probably going to take a look at that. Right. But it does take a lot of work, and you have to take it seriously as a vendor. And writing your code that's compliant with an awful lot of the privacy rules is a great big deal. So we probably spend more time with that, even though we and the applications we offer really operate mostly with public data, public information. We still try to comply with all the privacy issues that the banks want to have you look at.
No, but you know, while this issue affects startups, certainly, and having startups be able to even be certified, it also affects huge organizations. And FIS certainly is probably the largest company that supplies product and services to banks and invests hundreds of millions of dollars annually in the support of those products. It's got over 400 products, over 20,000 customers. So a huge amount of money goes to those products, but the products are led by the demand from the customers. And so what is unfortunately happening is the demand, much of the demand is now shifting to the regulatory, you'd have to call it burden, but the things that you have to do to respond to regulatory requirements. So what tends to happen now is part of the hundreds of millions, and a growing part of the hundreds of millions, goes to supporting regulation, period, in some form or another. And clearly, if you survey the entire customer base that FIS deals with, the number one issue that they will say, it's certainly the number one issue we heard at the FinTech Accelerator over the summer with banks that came here to visit, was help us comply with regulation.
Yeah.
And when you do that, it's terrific. FIS can make money doing that, but it doesn't really do anything for financial services for the end user.
That's correct.
Well, and if I could just chime in for a minute, if that's okay. Yeah, I think you've hit a real point and a bone of contention that certainly we've seen in our banks, and obviously we're going to see it crop up here in the other kinds of venues for marketplace lending, like we're seeing now. And Congressman Hill and I do not want to put unnecessary burdens on any kind of capital formation, and the court, and especially this kind of emerging innovation and collaboration that is really so exciting. But we are seeing many that are weighing in. We've already seen the OCC. They've issued some white papers outlining potential ways that regulators can possibly regulate fintech firms, talking probably more about holding them to some of the same standards as depository institutions, things of this nature. And I know the CFPB has already come up, whether it's dealing with Section 1071, trying to put out other rulings on this. That and French Hill's right about the status of the CFPB and then being kind of an outlier out there. And recently, I do have to mention, because it's just been in the last month or so, that a federal appeals court did rule that the CFPB had been operating unconstitutionally by stating that a director can be removed at will by the president rather than by cause. So they're kind of in flux, I would say, at a moment. But they too are looking to move into this segment and sector. And we've had hearings in the Financial Services Committee starting back in July, kind of examining some of the opportunities and say the challenges with the whole fintech industry and the development of online marketplace lending. And I don't know how much French you've delved into it here, but the McHenry legislation that's not worked its way through committee yet, obviously, but it's HR 6118, and this was introduced as part of the innovation initiative that I know Leader McCarthy talked about, and it mandates the creation of a financial services innovation office within the 12 different federal regulators in order to foster this innovation. So companies can apply for enforceable compliance agreements. This kind of follows the lead, I think, of what was established in the UK, where they have implemented this kind of regulatory sandbox, so to speak. So I think you're going to see, certainly in the next Congress, and as we move on, others try to move into this sector, get their feet wet, figure out just how it is that we're going to set up these kinds of innovation offices, what regulation has in the future. And the key here is that you all have a seat at the table as we move forward. So I'm certainly interested in where you all think this is going and how it may impact and affect your capital formation, your growth, your innovation.
Thank you, Congresswoman. Hey, Chris, so why don't you tell us a little bit? So on marketplace lending was mentioned. So how is Akouba different? What are you doing, and how do you compare to the marketplace lending that's got a lot of the press, particularly the lending clubs and the others? Why don't you walk us through a little bit about that?
Yeah, so the marketplace lenders, and there's many different names to address the marketplace lenders, online lenders, alternative lenders. There are many different subject matters. We could talk for hours about that. I think the biggest thing that what we looked at was what is best for the end consumer, and whether that end consumer is an actual consumer or a small business owner, what is the best for them? Is it easy access to capital? Well, the online lenders did a really good job at that. They really proved that technology gave easy, simple access to capital. But the problem was some of their business models, and not all of them, but some of their business models gave that easy access to capital, but at a cost that was frankly unaffordable. There are countless cases that we go through and we see with small business owners when using our system that we have found that they have been heavily burdened by the loans that they have taken from some of these online alternative lenders. And the banks that we work with are then trying to give them loans to fix the problems that have been caused by some of that credit that they have been given. So what we did is we took that idea of using a very simple, clean, technology-driven interface to gather customer data and then supply that data back to the bank so that they could make a decision much more quickly. If you look at it, a typical small business owner, when they're applying for a loan at a bank, on average applies to loans at 4 different banks. And it takes anywhere between about 28 and 34 hours for them to fill out all the paperwork to get that done. That's a lot of time when that business owner is trying to work 60 to 80 hours a week, making a living, paying for their mortgage, employing, some of the largest employment base in the country is done by small business owners. And now we're going to force them to spend 30-ish hours applying for a loan at a bank. That just doesn't seem right, but then it also doesn't seem right to get them online and apply for a loan in an hour and get that loan at a 39% APR. There had to be a better way. And so what Akouba did is it took that idea of really simple cloud-based technology, obviously very secure, regulatory compliant as well, and then white labeled that to the banks. So now a small business owner anywhere in the country could go to their bank's website or walk into that branch and apply for a loan just like they would for an online lender, but get that loan decisioned instead of in 4 to 6 weeks. They could get it decisioned in just a few days and then get their capital at a reasonable and affordable interest rate because of the way banks are run today. So Akouba's fully focused on helping the community, expanding our product to every bank around the country so that they can make these loans to these small business owners, and that small business owners in the United States can continue to grow. And I think, and I'll leave it here, I think one of the things that I always love talking about when it comes to Akouba is our name. Our name, it's an ancient Greek word which means to reach out. And so we take that as our software, giving the banks the ability to reach back out into the community and shake hands with their customers and clients, provide the right credit and help their community and grow their community, employ more people in their community. So I just always like adding that to it because we are, from the technology that we build to the name that's across my chest on our shirt, we are true to helping community and regional banks and helping the small businesses in those communities.
Awesome. Thank you, Chris. Stay on the line. We may want to ask you some more questions here in a bit. So speaking of reaching out, so our next participant on the call is Hexanika. Hexanika was a participant in the Venture Center's accelerator this past summer as well. With us today is co-founder and CEO Yogesh Pandit. Yogesh, you there? And if so, tell us about Hexanika and why you started the company.
Sure. Thank you, Gary, for this opportunity. And Representative Wagner, pleasure to meet you again in less than 1 week. That shows your contribution to enabling FinTech into this space. And Congressman Frenchel, nice to meet you again as well. So with that, I'm Yogesh Pandit, CEO and co-founder of Hexanika. At Hexanika, we have built a seamless end-to-end regulatory reporting software, essentially to simplify the regulatory burden, as Colin Andrews mentioned earlier, for banks. And before starting Hexanika, I was a senior vice president at Citibank, responsible for sourcing and collecting data focused on regulatory and compliance. And just at Citibank alone, the budget, yearly budget of compliance is more than $2 billion, B as in boy. And in spite of having that large budget and more thousands of people doing that function, there were sleepless nights and Citibank still had to pay fines. And that's when I reached out to my co-founders and I said, just adding people is not going to solve the problem. We need to use innovation. So Congressman Frenchel, you mentioned about big data, which is focused on customers. Why not to enable that for regulatory and compliance? And that's what we are trying to do. And as a result of that, we have been able to work with various banks in the industry and been able to get significant cost efficiencies up to 40%. And that also leads into further efficiencies and accuracies in reporting.
Thank you, Yogesh. Hey, Mike, so you've been involved with community banks for a really long time. And so I saw a report recently that said in 1985, Community Bank had this thing called the Call Report, which was a regulatory report that had something like maybe 403 items on it. Today, that same report for that same small bank is somewhere around like 2,000 items. So how does a community bank keep up with this?
French might be able to answer that a little bit better than I can, since how he had to actually answer it. I tell you how I use it. We actually use it as a prospecting tool, quite frankly.
Exactly.
Yeah. And the startling thing is that we actually know an awful lot more about any bank that we go approach than they know about themselves, just by spending a modest amount of time going through looking for the metrics that are important to our product, picking out the prospect and going and talking to the bank. It does take a lot of time. It's very dated information by the time you have access to it. It's not handled very consistently inside the bank and how they fill it out. A lot of banks, put a lot of data together. They do their own interpretation of what the data is meant to be. But they're asking for an awful lot of information now, and I think it takes a lot of time to get that filled out and reported on time. French, what did you find?
Well, I would say that this is an important innovation, and I'll just use Citibank as an example. I think the biggest banks in the top of the food chain have an obligation under Dodd-Frank to do what's called a CCAR test, which is a very advanced capital test as a part of the post-08 crisis. And if my memory's right, Citibank has like 500 models that have 10,000 pages in them and aggregate way over 100,000 pages of supporting documentation for a test, one test of many that they're supposed to do at least on an annual basis. And something I think our committee, and I'm lobbying my colleague Ann Wagner on this live feed here, one thing that bothers me is there's no materiality test in that.
Right.
So that Citibank has a small consumer loan portfolio in Brazil that's not material to Citibank itself. It requires the same level of data analysis and data analytics and documentation that their largest business unit in New York might. And that, to me, as a business person and as a member of Congress, doesn't make sense. So I hope that our committee in the upcoming Congress can talk about that issue as a materiality test, which we all have under GAAP,
right,
and see if that isn't a way to tackle part of this paper avalanche. But it's impossible to run these businesses without this kind of use of big data and mining it and getting it to do part of the work. You can't hire enough compliance.
One thing that I find rather humorous these days is that they still require an awful lot of stress testing on rates, and they require us actually to go to like -300 or -400%. Yeah. And it's like interest rates cannot possibly go that much negative, I don't believe. So we spend a lot of time talking about that. It spins our ALCO committee into an absolute tailspin when they see that, and it's meaningless information.
Yeah, we were, Mike and I served on a board together, and we literally were paying several $1,000s a quarter for the asset liability interest rate sensitivity testing done on the assets and liabilities of the whole institution. And they wanted to get, you know, a negative 500% move in market interest rates. And if we didn't do it, we were
not being
not in
responsible.
compliance.
Yes, right, not in compliance.
Yes, thank you.
Well, and let me just chime in. Let me chime in if I could. And Yogesh, I hope you're still here. But you know, since we're having this discussion about all of this paper and all about big data, I think what and maybe you can talk about it a little bit, Yogesh. What Hexanika is doing about data lineage and your concept of starting with the data and not the this overflow of reports, and how what's key is actually the data points and the data lineage. You know, if you could develop that a little bit more and talk about your innovation, because I think that's something that's can be very, very useful going forward.
Sure, and to further speak about what I'm just trying to suggest is, since the Dodd-Frank Act, one of the most important aspects that the regulators want and also the auditors want is end-to-end traceability. From that report line item through the source, there are a lot of transformations, adjustments that happen, and it is really difficult at this point of time to have that data lineage and traceability in the way the current regulatory reporting functions. And that's where end-to-end reporting and having that traceability is extremely important, and our software enables that, number one. Number two is there are three things coming to actually the regional and community banks, which is the largest focus in the Midwest area. The simplicity, smartness, and efficiency is the key. And what is the simplicity? Just getting these different types, formats of data and automating this data sourcing and management, which leads into this data lineage, number one. What is the smartness? It is the use of machine learning and big data. And to Anne's point, when we met last week, and if you remember, and we spoke with Frenchel also last time, is about redundancy in regulation. The same calculation goes to different regulators and different reports. So our software automatically identifies this redundancy that go into these different reports, and the calculation is sourced in different reports, resulting in consistency of reporting, which is very important as well. And the third thing about efficiency is, because we are using innovative technologies, it leads to more accuracy, consistent, and timely reporting. And that is more important for especially the community and regional banks who do not have this large chunk of money the way Citibank or JP Morgan of the world have. So enabling automation and reducing dependency of resources and people to keep up with these changes is extremely important, and that's what we enable. Thank you, Anne, for that question and comment.
Yeah, I mean, simplicity. I mean, listen to these words. French, this is what we're looking for when it comes to regulation. Simplicity, smartness, efficiency, consistency. These, you know, if we can get this kind of data lineage and data and reporting with some level of consistency and efficiency that all regulators can see and understand, think of the money that can be saved in terms of compliance costs and headaches and yeah, I think the sky's the limit, and I believe it's these kinds of innovators that are going to make this happen in the future. I really do.
Congresswoman, while I have you on, this question came in from the web. The question is how might future legislation affect standalone FinTech startups, and are there any kind of indicators? So along that whole line around simplicity, so forth, what are your thoughts about that?
Well, I think we've got to look at the entire industry first. Standalone, you know, I'm not sure what in particular they're would be talking about here. I do think that we have to be very, very careful here about new regulation in this area going forward, and we don't want it to go too far. This is a new and promising industry, and to think that it could be crushed by too many regulators is a scary thing. So I'm pleased about 835 and our resolution, which is really just a sense of the House about where we need to go. And I think you're going to see ongoing hearings and debate and discussions about this within the Financial Services Committee. And then also, I would submit to you this legislation that our colleague Patrick McHenry has put forward with the number HR 6118. Don't know what it'll be in the next Congress here, but this whole concept of the creation of a financial services innovation office within these different regulatory agencies, not to be there to be overburdensome, but really to foster innovation. I think this is the route that you're going to see us going when it comes to any kind of, I hope, any kind of regulatory nature going forward.
I just want to just briefly, you know, we live in a digital world, but our regulations and our government agencies are all analog. And that's a huge problem. And there's a communication problem, there's an application problem in that. I mean, we've really gone from the 1930s to a paper-based system all the way to digital, and we haven't really changed the system. We've just digitized the analog paper information. Now we're talking about making a leap. And so this is going to be the source of hearings. And I agree with Representative Wagner that McHenry's legislation is headed down the right corridor in that if we have an innovation center in each of the regulatory agencies, maybe that'll be a way to let them advance innovation that's not bank owned. Because I think that's where the questioner is coming from. What if I want to innovate in a consumer or a business-to-business product, but I'm not a regulated broker-dealer or I'm not a regulated bank?
Right.
Can I do it? And the answer right now is there is not a special charter with no rules. And so I think Congress will debate out, is that a possibility? And you can imagine all the cans of worms that opens.
Well,
really.
yeah, as a matter of fact, to that point, I mean, you should try and pay some attention to the banks, the financial institutions, and to helping them through some of this too, because they're being crushed with all the regulatory requirements around taking deposits, making loans and that, while the FinTech attackers, if you will, are coming in, and they're not being forced to think about reserves and losses and a lot of things like that. So that's a very interesting line that I have to walk
But I just would say, I'll turn to my friend Collins, but under existing law, statute, if you don't take deposits and make loans, you don't have to be a bank, and therefore you don't have to be bank regulated. It's only when you take deposits and make loans, still under the statutory framework, that you're then considered a commercial bank.
Sure.
Which brings up the question of how do I fund myself if I don't take deposits? But because of the burden on today's banks, and after post-Dodd-Frank, almost every financial activity in our country has been pushed out of the banks now that are being funded by lending arrangements, syndicates, and private equity firms.
Right.
Yeah, I was
Yeah.
as you guys were talking, the two things came to mind about that. One of them is one of the reasons, or one of the opportunities for FinTech companies is the complexity of regulation. Interestingly enough, I mean, it's kind of looking at it from a different point of view, but the business that Yogesh just described is created because regulation is so complicated, and particularly the supply of data from regulation. So there is an opportunity to respond to demand in whatever form that demand hits, and companies like FIS look at that as an opportunity, although I think we would much rather spend the money in ways that makes a profitable difference to a bank. But back to the subject of what did we hear from the banks when they came here and wanted to tell us what their problems were. The number one problem was response to regulatory issues, and the number two problem was the problem of non-banks competing with them and them not having what they consider to be a level playing field to do the things they needed to do to make depositing more simple, to do more of the services remotely, to attract millennials. Those are the kind of things they were talking about, and it became difficult because there were non-bank entities that were not regulated in the same way that were their competition.
Gary, I know you're moderating this. Unless you have other questions, I'd love to pose a question to the congressman and congresswoman. How do you feel about, kind of like the question that came in, whether it's a standalone FinTech company or someone like ourselves that tries to work with the banks and sell our software to them, how do you feel about private and public partnerships? You know, there are regulatory agencies that exist. You yourselves are considering different types of regulations or laws that you're going to pass. What about engaging with startups like ourselves or with Hexanika and Yogesh or many others and having, Congressman Hill, you said, you know, having an internal innovation team. What about a board formed by executives of these FinTech startups, or forming partnerships with some of these FinTech startups to either help make the regulations that are getting passed easier to manage, or understanding the startups' perspectives of these regulations and how to work with financial services in some sort of public-private partnership way? I'd love to hear your thoughts on that generalized subject matter.
Well,
let me just,
yeah.
I'll chime in real quick and say that I am all for it, which is why I talked a little bit about Yogesh's and Hexanika's plans and going forward. I think there's a lot of room in this space for those kinds of partnerships when it comes to innovation, and not just when it comes to data lineage and reporting requirements and the simplicity and the smartness and efficiency and all the things that we talked about, but also in the area of cyber, let me just say. And we've had some discussions at 6:30 about this. I think there's great room for partnership of a public-private nature, especially when it comes to the cyber area, because it's not just the retailers and the banks and the power grids and everyone else that are out there interested about cybersecurity. The federal government, believe me, should be and is very, very interested in this area. And I think there's a lot of room for fintechs in this space to be big players in that area. And I'm sorry, French, I'll toss it off to you.
No, I think Congresswoman Wagner's right. That's a key area where you see public-private partnerships now. I mean, the cybersecurity area is a major collaboration between the federal government, the FBI, the biggest banks, both for money laundering point of view and for global hacking and criminal activity. So the opportunity for fintech companies is to innovate how to advance that data search faster and look for bad actors quicker by disruptive technology. So I think that's important. And then I think, how do you comply with existing regulatory burdens? That would apply to the receiver as well. When you think about going through reams of data, if you're at the Federal Reserve, how am I going to look at 100,000 pages of someone's capital analysis and determine any value in that? So they need digital innovation themselves in their oversight capacity. So I think you're on to a good direction. And sometimes in government, when we want to punish bad actors in federal regulatory agencies, we curtail their spending, and we curtail it across the board, including in the IT arena. And I personally have been on record saying that's a mistake. I mean, we need, if we want cybersecurity federal records and we want them doing a good job, we need to make sure they have a platform that's a contemporary platform and not one that's was built back during the Nixon administration.
this issue of public-private partnerships, I think it's interesting that that came up in here. That is a subject we learned some about as we ran the FinTech Accelerator here in Little Rock. This is it's not just an opportunity for federal partnerships, but also state and local partnerships with FinTech companies, because the promotion of a FinTech business in a given geographic area means so much to that community. And it is very difficult for any one private company to make this happen in a significant way. And when you combine the benefits of a private investment, in the case of FIS, of the benefit of looking at innovation and innovative companies in an aggressive way, but if you partner that with a government entity of some sort that also stands to gain, I think it's much more likely we can push this sort of thing forward. We learned that here, and we will be able to do this again in the future. And then in this case, it's private companies and state investment.
So Gary, one thing that I would like to mention is just last week we met with Federal Reserve, and they have been extremely supportive in what we are doing, especially for the regional and community banks. In fact, to my surprise, what was mentioned also, that banks are already struggling, but only up to 60% of Dodd-Frank is implemented as yet. So there are more regulations to come as a result of Dodd-Frank, and there is Basel and other regulations are coming. So that was also something that is going to put more burden on the banks, so on top of the problems that they already have. But looking forward towards working with the regulators, and if there is any forum, that would be appreciated. Thank you.
And so as we wrap up this live stream, Congresswoman Wagner, I'll give you the last, I'll give you a question and your last response, and then turn it over to Congressman. So with the current political climate, obviously going through an election season and maybe some changes in the Senate, what's next for regulation? And really, I guess more as important is, what can the participants that watch this YouTube, how can they help, and how can we participate in the process?
Well, loaded question, and ask me that on Wednesday morning, maybe. But no, I'm hopeful for the future. I will say this: French and I, and the work that we do on the Financial Services Committee. I serve on the Capital Markets Subcommittee, and then also on Oversight and Investigative Subcommittee. So this is important, and we think we've begun the dialogue in the 114th Congress, recognized that I think the great contribution that these incubators and accelerators and these fintechs are going to bring to the industry, which frankly was brought about, I think, in large measure, not just by the technology, but as a way to fund some of these things outside of the normal banking process. I think, what we're going to be continuing to do is to have the kinds of summits and meetings with the regulators, with the stakeholders, and discuss the industry and how best we can encourage innovation, encourage cooperation and collaboration without coming in with a sledgehammer from a regulatory standpoint to thwart the technology moving ahead. It was interesting when we had our meeting at 6:30 last week. Some of the real stakeholders who were at the table were some of the major banks in the area. They know that if they're not there and a part of this technology moving forward and going ahead and being a part of some of these public-private partnerships that you're going to see, they're going to be gobbled up in the process. They both need the kind of innovation that you all are developing, and they need to be able to incorporate that into their own institutions and their lending practices, I think, going forward. So, I'm hopeful and excited that about the fact that we as legislators, French Hill, myself, and our other colleagues on the Financial Services Committee, will be able to guide this towards the area of innovation and cooperation and collaboration that's going to grow industry and not put a cold towel on it anytime soon.
Well, Gary, thanks you and Collins and Mike, and appreciate the Venture Center hosting this. This is always great to be here and demonstrating the good things we're doing here in Little Rock and venture capital and the contribution of FIS. We appreciate it. And Wagner, I appreciate partnering with you today and the work you're doing in St. Louis. I would conclude by simply saying that innovation takes place in the private sector. And we need to make sure that we facilitate private sector innovation in the FinTech space. And that the next Treasury Secretary, the next Director of OMB in the administration need to know that and have that as a focus of their work, that they're going to look at regulatory burden and right size it and recognize where there are so many unintended consequences and costs of regulations that it's actually deterring innovation, be it by an existing commercial bank or by a non-bank innovator. So the first place we have to start after November 8th is to make sure that we have a Treasury Secretary and a Director of OMB, the Office of Management and Budget in the White House, that are pro-innovation, pro-private sector innovation, and that they know that there's the regulatory costs in this country over the past decade has been too high, that it's gone beyond safety and soundness and consumer protection, and it's, in my judgment, been a detriment to innovation, not only in the financial services area, but in many other areas in our society. But thanks for having me.
Thank you to the Venture Center for hosting this live stream. Congressman Wagner, thank you for your participation. Congressman Hill, good luck to you next week. And thanks for the panelists. And that concludes this webcast. Thank you.
Thanks so much.
Thank you.